Good morning and welcome to ROBO Global's first quarter 2020 investor call. My name is Bill Studebaker. I'm president and CIO of ROBO Global. Joining me in the call today are Jeremy Caprone, our director of research, and Nina Deca, who is a senior research analyst. Both are based in New York. Also, we have Aaron Shepard, who is the head of our digital marketing that is in Dallas. For those of you that may have questions during the call, feel free to email them at info@roboglobal.com, and we'll be happy to address those at the end of the remarks. We'll try to make this pretty quick, about 15, 20 minutes, and then again, open up for questions. Before beginning, we would certainly like to express our deepest sympathies for those dealing with the virus, and especially for those who've lost loved ones. This certainly is a very difficult period of time for the entire world, and it's encouraging. At least now we're starting to see the curve that's flattening, and hopefully we're going to have a cure for the virus in the not too distant future. Before we begin and review our investment strategies, I'd like to just provide a quick update on our company. For those that may or may not be aware, ROBO Global is an index advisory and research company focused on helping investors capture the growth and innovation in robotics, artificial intelligence, and healthcare technology companies all around the world. And believe it or not, almost 7 years ago, we created the first index that tracks this value chain, given our belief that we are on the cusp of ubiquitous automation, and the coronavirus certainly will not stop this. Today, our investment strategies are tracked by in excess of $2 billion in AUM globally, primarily in ETFs and mutual funds all around the world. We are investing in technology disruptors that are helping to create what we see is the new economy. We're clearly in a transition to an asset-light economy in areas such as data and algorithms versus historically before, which was fixed investments in plant, property, equipment. And we see many of these companies, of our companies in our three indices, gaining share coming out of this crisis, especially in areas in artificial intelligence, automation, enterprise software, and healthcare technologies. And for hundreds of years, the fundamental drivers of the economic growth that we've seen have been as a result of technological innovations. And we believe the most important general purpose technology of our era is robotics and artificial intelligence, particularly machine learning. Again, robotics and AI are on center stage. Next slide, please. Our indices are based on a research-driven selection of what we believe are the best-in-class companies, combined with the discipline of index investing and a strong ESG policy. As you can see on the next slide, we are fortunate to work not only with investment professionals, but also with an amazing team of industry experts, including some of the most prominent thought leaders in robotics and AI. We employ and utilize this strategic advisory board, which includes 7 PhDs and some of the most highly respected technology visionaries who work very closely with our management team to identify key industry trends and associated companies. During the crisis, we've been fortunate to have hosted several conference calls with their advisors and many clients that really have been exceptionally well received, given their perspective on being the front lines of this pandemic and the industry. And as experienced investors, we know how difficult it is to pick winners over the long term. So to tackle this task, our team spends the bulk of our time doing deep research, identifying trends, understanding innovations, and exploring every company on the radar and below the radar. And Jeremy and Nina will discuss a few names in their prepared remarks. As you can see from the next slide, the first quarter obviously was an unprecedented market sell-off, and in our opinion, represented more of a natural disaster than a financial or economic event. All three of our indices declined during the quarter, as you can tell, but definitely outperformed global indices in the quarter and on a 1, 3, and 5-year basis. Please note that the ROBO Index has over a 5-year history, but that's not the case for our AI index and our healthcare technology. And so the data presented here includes a back test of the initial portfolio for the periods prior to inception. Importantly, year to date, Robo now is down about 13.5%. HTEC is down 4%. Think is down 6%, and that compares to Ackley, which is down about 15%. So again, I think that we're coming out of here in a good position. And moving forward, while I don't have a crystal ball, I do have optimism that we're going to come out of this. Most people, or for most people, there's simply no room for certainty in investing, and that's certainly true today. I would say that all great investments begin in discomfort, and one thing for sure is that there's great discomfort today, and most investors seem to think they want to buy at the bottom, and by definition, we don't know whether that's been reached, since that's a function of what will happen tomorrow. So for investors to say, I'm going to wait to the bottom, I believe that's an irrational statement. The investor's goal should be to make a large number of good buys, not just a few perfect ones, which is what our focus is. And we actively rebalance quarterly to a modified revenue weighted model, which we believe works well because we smooth out the ride. And our rebalance occurred on the lows of the market on March 23rd. And again, we think by rebalancing quarterly, we think this is going to help smooth out the ride. If you look at the next slide, I guess, which is, our portfolios really have been less impacted by the coronavirus. And you can see this is a little bit of a busy slide, but you can see here that generally speaking, our portfolios are not exposed to the areas that is right in the crosshairs of where the crisis is hitting, which is energy and travel, hospitality, leisure. We didn't put in housing or financials, but we probably could have put that in there, as well. And we think, again, coming out of this crisis, I think our portfolios are well positioned to gain share and grow. You can see another interesting aspect about our portfolio is that all of our indices have exceptionally strong balance sheets, and this is, we think, paramount in the new world economy that we're going into. As you can see, Robo has and HTEC both about 60% of the companies have a net cash position. Think it's about close to 70%, which compares very favorably to global indices. You can see S&P is at 15% and the Qs are around 42%. The next slide, we think, is also very representative of our index, which is, we think, coming out of the crisis, when it actually does happen, what's going to lead the way are going to be small and mid caps. And we think we're well positioned to deliver growth for investors here. 30% of our exposures in large cap and 70 mid and small. In Robo, the median market cap is roughly 5 billion, and Think it is around 7 billion. We also, you can see, pretty diversified across geographies, with 40% in the US, 35% in Asia, 22% in Europe, and 3% the rest of the world. I would say that one area that most investors probably would have concern would be, Europe. Asia's already started to come out of the pandemic. Europe is an underweight position for us. So we think that, again, we are in a favorable position, going forward. The last thing I want to say before passing on to Jeremy is that please take a look at our website. We've developed a lot of content. And one note I'd like to bring your attention to that I think supplements what Nina and Jeremy are talking about is that we see 3 waves of growth coming that's really being supported by robotics and AI. And one of the waves that we talk about is supporting stability and business continuity. And clearly robotics and AI are doing this. There's no better representation than what's happening in e-commerce and warehouse automation. That's allowing us to social distance ourselves. These technologies are enabling that. The second wave that we see coming about is we are institutionalizing new ways of work. One industry that's gone basically from being a niche application being to right at center stage is telehealth. And I think Nina will talk about that. We're going to need much more mobility. That's definitely happening. New industries are being created. And the final wave that we see coming is that we're learning from the crisis to prioritize tomorrow's tech transformation. So what I mean by this is that now, given what's happened, what do we need? We need definitely more bandwidth, and we need 5G. Both of these we think are going to come much more quickly than a lot of people might have expected. So that's my prepared remarks. I'm happy to pass it over to Jeremy.
Thank you, Bill. So let's talk about ROBO. ROBO is a research-driven index of best-in-class robotic, automation, and AI companies from around the world. And it covers the entire value chain, from the core technologies that make automated systems possible to the applications across manufacturing, logistics, healthcare, consumer, etc. And as you can see here, it has outperformed the World Equity Index over time, including in the past quarter, the past 3 years, and the past 5 years, with annualized returns about double those of the MSCI Global Equities Index. And the ROBO Index was down about 20% in Q1 after rising 30% last year. And 3 months ago, just before the virus outbreak started derailing the economy, we thought a new capital investment cycle was about to start after an 18-month slowdown in global manufacturing and continued strength in the consumer economy. Of course, we are now in a very different situation, with the majority of ROBO Index members currently experiencing some significant business disruptions. However, we expect robotics automation companies to emerge from this crisis on a stronger footing. And clearly, if there's one area where corporate investments are firmly set on a strong growth trajectory, it is automation and AI. And Bill already gave a few examples, but let me emphasize a few more. First, the logistics and warehouse automation. That accounts for about 10-11% of the ROBO Index by weight. And it will benefit from the enormous strain that's currently put on e-commerce as consumers are stuck home. We think this is creating a step up in terms of adoption of e-commerce, and that will boost demand for logistics and warehouse automation solutions. It's not only now, but on the other side of this crisis as well. So companies like Ocado, the UK online grocer and provider of fulfillment technology to Kroger, or Daifuku, a Japanese company that's the global leader in material handling equipment, or Zebra Technologies here in the US, those are likely to benefit. And the second example is computing, processing, and AI. That is the largest segment of the ROBO Index here. And this is really the backbone that enables many aspects of remote working, and I'll come back to that. The third example is healthcare automation. That will be in high demand once the pandemic recedes. And I will let Nina talk about it in more detail shortly. And finally, factory automation is bound to accelerate further as manufacturing businesses realize the risk presented by human labor shortages. The factory automation accounts for about 1/3 of the index. And in the short term, we think factory automation companies will experience a meaningful drop in orders because customers are postponing capital investments. And the strongest headwind over the next few quarters will probably be around the auto industry, which we estimate accounts for 7% of the ROBO Index revenue. So it's no surprise that the worst performing index members during the quarter were the companies with a high exposure to the auto industry. The first one is Aptiv, that is a system supplier to automakers that is focused on active safety and also produces a network of software and sensors that can be outfitted onto existing cars to make them autonomous. So Aptiv stock declined 48% in Q1 as auto factories shut down in China first and in Europe and US, but it has already around 29% so far this quarter. And the other underperformer in the quarter was Nachi. Nachi Fujikoshi is a Japanese company that also has high exposure to autos, around half of its sales. It's particularly factory robots that are going to Toyota and Honda as well as bearings and other components, and the stock was down more than 50% in Q1. The best performers we saw were Israel Vision and HTEC Vision. And Arian, if you could move to the next slide. Yes. Both are companies focused on computer vision that is giving the sense of sight to machines. ISRA is a German company that has been a member of Robo since inception in 2013. ISRA agreed to be acquired by Atlas Copco in a public tender offer at a 43% premium to the closing price the prior day. And this was the 9th takeout of a Robo member in the past 6 years. And we actually had a 10th takeover in the quarter with QIAGEN in the healthcare subsector agreeing to be acquired by Thermo Fisher. HTEC Vision, that is a Chinese company that is the global leader in video surveillance and also a strong player in computer vision. The stock was up 18% in the quarter after the company lifted some concerns around a possible disruption resulting from the company being placed on the US entity list. Now, HTEC Vision was removed from the Robo Index during the quarter due to failure to comply with the ROBO Global ESG policy. On the next slide, I want to discuss a couple reasons to be optimistic here. We think this setup is attractive for robotics, AI, and automation stocks. At the end of March, the equities of best-in-class automation companies from around the world are trading on a trailing price-earnings ratio of 21 times. That is a 20% discount to the long-term average of 25 times, and significantly below the high of 31 times reached in 2017. So we think the market is already pricing a more than 20% decline in earnings for 2020. And our base case is that earnings will trough in the second quarter before improving sequentially from Q3 onward. And finally, I want to make some comments on the Robo portfolio as it stands. Our methodology combines this research approach for company selection based on long-term value drivers with the discipline of index investing. So we more or less equal weight the stock to give a fair representation to smaller companies, which in many cases are attractive takeover targets, and they offer higher growth potential. And every quarter we reconstitute, we rebalance the index, which means that we sell our winners and we buy our losers, which is the way to sort of ensure that the index buys low and sells high. And if you look at the pie charts here, the key word is diversification. Across sectors, across countries, we have about a dozen countries represented, diversification across the market cap spectrum, and there's a strong tilt towards small and mid caps, which represent nearly 2/3 of the portfolio. And the overlap with traditional market indices like the S&P 500 or global equities is very low, under 3%. So investors generally do not own these stocks. And with that, I'll pass it on to Nina to discuss the Healthcare Technology and Innovation Index.
Thanks, Jeremy. Just first of all, let me give you a little bit of background about the Healthcare Index. So in June of last year, we launched the Healthcare Technology and Innovation Index, HTEC, which is comprised of about 85 of the most disruptive companies in healthcare. And what this does is it helps investors capture the value of the rapid disruption that's happening in healthcare. HTEC's focus on new technology is unique compared to other healthcare indices because it's more heavily weighed in innovative areas such as telehealth, genomics, precision medicine, and so on. So the index trades under the ticker HTEC in US, HTEC, and ticker DOCT in Europe. And then as you can see in this slide, during the first quarter, HTEC returned a negative 11%, beating the world index of negative 21% and fairly in line with the S&P Global Healthcare Index return of negative 11.2%. On the next slide, we drill further down into our performance by sector, by subsector, if you will. The left chart illustrates how we segment our index, like I mentioned before. So we believe these 9 areas represent the most disruption across healthcare for today and, more importantly, for the long term. On the right, we see the top performing subsectors in the quarter, which were telehealth and data analytics, each returning a positive 33 and 1% respectively. The lower performing subsectors, medical instruments and robotics, each returned a negative 19%. So the performance, we'll stay on the slide for a minute, is very reflective of the overall demand for healthcare products and services in the wake of the coronavirus outbreak. Technologies that were supporting or have been supporting remote patient care, such as telemedicine or diagnostic and treatment of the coronavirus, like testing, vaccines, are seeing high demand. And the stocks related to this demand outperformed the other subsectors during the quarter. For HTEC, about a quarter of the index members have taken part to address or treat the new coronavirus. For example, in telehealth, which was the top performing subsector, companies like Teladoc and Ping An have seen accelerated demand for remote doctor-patient visits. Telehealth is also being increasingly used to help keep clinical trials on schedule and also to remotely monitor patients that have chronic illnesses. For example, patients on dialysis are increasingly seeing doctors right now using remote patient monitoring and remote visits. Data analytics companies like Livongo are increasingly being used to monitor people with other chronic illnesses such as diabetes and hypertension. As we transition to the lab, it was Illumina, another HTEC company, that it was the Illumina instrument that was first used to identify the SARS-CoV-2 virus, which was the virus that causes the COVID-19 illness. And then also HTEC companies like Quidel, Roche, Thermo Fisher Scientific, and Danaher have all launched a range of diagnostics, from rapid point of care testing, where one small instrument can test for coronavirus in a few minutes, to high throughput testing, where one large instrument in a lab can process thousands of instruments per day or thousands of tests per day. In therapeutics, HTEC members like Regeneron and Moderna, also Insight, have been working round the clock to develop treatments and vaccines. And some of them have already begun clinical trials in humans, Moderna specifically. Regeneron is also moving at an unprecedented pace and looks to have a vaccine in human trials by this summer. Conversely, due to the hospital constraints and the global measures to control the spread of the virus, various medical procedures have been canceled or delayed. Anything involving something that can wait, like eye surgery, knee replacement surgery, these types of companies that offer these products and services in the near term took a bigger hit. And this has also impacted, the coronavirus has also impacted hospital budgets to buy new instruments and robotics platforms. Hence, the lowest performing subsectors of the quarter, medical instruments and robotics. And in the next slide, we'll see the top, the best, among the best performers and among the worst performers in the index. We have Teladoc, which we recently mentioned, providing the infrastructure for remote patient doctor visits. Quidel, a diagnostics company that received authorization in the US, Canada, and Europe to manufacture and sell a molecular test for the SARS-CoV-2 virus. This test that Quidel is offering can be widely used on thousands of instruments that are already owned around the world by Applied Biosystems, Roche, and QIAGEN. So Teladoc, Quidel were the best performers, and then on the downside, we've got Glaukos and CONMED among the lower performing companies in the HTEC index during the quarter. CONMED is a medical technology company that makes products used in general surgery and orthopedic applications, which, as I mentioned previously, were largely delayed or canceled due to their elective or non-essential nature during the global pandemic. Glaukos is another victim of delayed elective procedures. This is the market leader in glaucoma treatment, And they joined the list of many other corporations during the quarter to have removed their FY20 guidance. That said, both of these companies have strong balance sheets. They are market leaders. They are also technology leaders. And we continue to believe that the long-term opportunity for the growth remains even after the coronavirus headwinds have passed. So we believe this for most of the companies that had a rough quarter in Q1 in HTEC, that generally speaking, the procedures that were delayed are going to be rescheduled. The robotic instruments that were delayed in purchasing are eventually going to be purchased. And people with diabetes, cardiac illness, and cancer aren't going to get better once on their own once the coronavirus passes. So all of this innovation and new technology is going to continue to be needed for years to come. And so what does this mean moving forward? And as you can see on this slide, what we do is we have a breakdown of the different types of sub-industries in healthcare and the HTEC exposure to these sub-industries compared to the Global Healthcare Index. And as you can see, the Global Healthcare Index is much more heavily weighed in large cap pharmaceutical companies, whereas HTEC is more diversely allocated around some of these other areas that we consider to be representative of disruption and meeting vast healthcare unmet needs for years to come. So as we look at the future in a post-pandemic world, the world mindset is going to shift, and people are going to say, people who use telemedicine for the first time, which is a very quickly growing number, are going to look back after the pandemic and say, well, why don't we use that more often? If someone's not feeling well, why should they come into a doctor and potentially risk getting other patients sick when they could just get treated for a lot of illnesses at home? So we expect to see continued rapid adoption of that type of technology. There's also going to be a lot of government funding that is going to go towards science to further accelerate the innovation in life sciences, in precision medicine, genomics, and diagnostics. And then there's going to be further funding to help make sure that if there is and when there is another pandemic, that we are prepared, not just in the US, but globally. So we actually did an analysis, and we expect that roughly 20% or more of the HTEC index is very well positioned to see increased demand driven by greater utilization coming out of the pandemic. If we go to the next slide. A quick recap here, bringing it back around to the index portfolio, the characteristics of it. And I just want to call out, if you look at the center in the top 10 holdings, you'll see a representation there of some companies that are probably not owned in a lot of other indexes. And then similar to what Jeremy pointed out previously, there is a broad range of diversification in several ways, from industry classification, upper left, to geographic breakdown on the lower left. Over 20% of the index is outside of the US. And then market cap breakdown. When you're investing in innovators, you're going to have greater exposure to smaller and mid-cap companies than you might in other traditional healthcare indexes. If you look at the right on the top, we've got comparison and overlap with the S&P 500 and the World Index. Both are less than 5% overlap. And with the S&P Global Healthcare Index, there is less than 20% overlap. The reason why we think that's important, if you go to the last slide, is if you back test the companies that we invest in that are in the index, you can see that the performance over a 10-year period, nearly 20% has outperformed the other indexes, both global and world equity index. So by investing and continuing to focus in this innovative area, we think that it's an opportunity for investors to capitalize on a lot of this disruption. I'll stop there and shift back over to Bill.
Actually, Jeremy, do you have some comments on THNQ, please?
Yes. So let's talk about THNQ, which is our artificial intelligence index. that is a research-driven selection of companies at the forefront of the AI revolution. It covers key technologies that make AI possible. So think about semiconductors, networking, cloud providers, and cognitive computing, as well as key AI applications across business process, e-commerce, consumer, healthcare, industrial markets, etc. The AI index declined just under 15% in Q1, outperforming global equities and the S&P 500. And annualized returns over the past 3 and 5 years are in excess of 20%. And this includes a backtest for periods that are prior to August 2018. On the next slide, we look at performance for each of the 11 sectors that compose the index. And you can see that cognitive computing and cloud providers outperformed, with many companies providing vital solutions for the technology and business infrastructure to accommodate remote working and remote learning. E-commerce also was a top performer in the quarter. In fact, nearly 40% of the Think Index members are enablers and providers for the data center ecosystem and advanced communication technologies. And longer term, the secular demand trends that were in place prior to the COVID-19 crisis, think about the shift to public cloud, AI, data encryption, digital transformation, all these will remain a top priority as these next generation technologies enable business flexibility and offer significant revenue opportunities. In fact, the move to remote working and remote education is driving demand for hardware, such as PCs, laptops, mobile tablets, and cloud services. And users are engaging in streaming and social media more than ever as they are staying at home. It's become the key way we're communicating with one another. And many of the Think Index members are participating in this trend. So anything digital, online grocery, e-commerce, shopping, online gaming, collaboration software, cloud storage, cybersecurity, they're all seeing explosive growth right now. And I think that explains why many of these stocks outperform the equity market in the quarter. Companies in our consumer and e-commerce sectors with exposure to streaming media and online shopping, so think about Netflix, JD.com in China, or Amazon, they all outperformed during the quarter. Shopify, the e-commerce platform, also finished in positive territory. And our semiconductor sector was down in the quarter. There were some headwinds from supply chain disruptions due to the pandemic. But NVIDIA was up 12%, AMD was up 15%. Both continued their momentum thanks to rapid product cycles and growth in the data center infrastructure. We think that this year's CapEx recovery around the cloud infrastructure will be driven by continued surge in demand for streaming, e-commerce, and gaming. We're seeing higher network traffic, and that's driving revenue for many of these companies. Now, in terms of significant stock moves, I already discussed JD.com, the Chinese e-commerce and logistics company. Another top performer was Tesla. We think Tesla has a multi-year lead in electric vehicles and autonomous driving technology compared with traditional automakers. And Tesla has now delivered its 1 millionth vehicle. And its delivery and production numbers were better than expected in the first quarter. In fact, Tesla saw a 40% increase compared to a 29% decline for the overall US auto industry. And on the downside, Amadeus was one of the worst performers. Amadeus provides advanced transaction solutions to global travel companies, airlines, and the hospitality industry using AI to optimize supply and pricing. So that the Amadeus is suffering from the problems that its customers face in global travel. I want to finish with a quick overview of the Think Index portfolio as it currently stands. And once again, Here, the key word is diversification. Unlike market cap weighted indices, this is not a concentrated portfolio of large cap tech companies. It is a diversified index of companies from around the world that are driving the deployment of AI. And you can see that small and mid caps account for around 40%, and international or non-US stocks account for around 30% of the index. And you can also see it has a high active share relative to the S&P 500 and global equities. And I'll leave it there and pass it back to Bill.
Okay, thanks, Jeremy and Nina. So I guess I'd just wrap up by saying, as the pandemic continues, countries all around the world, from Europe to Asia to Americas, are dealing with it at different stages and reacting to crisis. But the reality is, for investors, this is creating unique opportunities. And I think for many investors, it's important to kind of turn down the volume on the day-to-day volatility and focus on investing for the future. And as we look past the current crisis, foundational technologies like robotics and AI are poised to improve productivity, lower costs, and drive growth in nearly every industry, making them vital to enabling our economy in a post COVID world. So any great crisis creates opportunities. We think once the battle against the coronavirus is over, and I'm confident we're going to win, robotics, AI, and healthcare technologies are going to create a better future for us all. So with that, we'll stop with the prepared remarks. If there's any questions, feel free to send them to info@roboglobal.com. Otherwise, on your screen in the top right corner, you can click on the tab and email in a message.